Singapore Central Bank is keeping its monetary policy unchanged, in line with analyst expectations. This means no change to the current rate of appreciation of the Sing dollar. It's also the fourth time in a row the policy is kept steady amid inflation risks. The central bank says standing pat will ensure medium-term price stability. It will also closely monitor global and domestic economic developments. In January and February, core inflation averaged 3.4% on year. For the whole of 2024, core and headline inflation are expected to range between 2.5% and 3.5%. For now, some economists expect monetary policy to remain unchanged, but this really does depend on the situation.
If we are going to see an upsurge, in global inflation way beyond, market consensus, and if MAS deems, global inflation to be detrimental, to growth as well as threatening its medium-term price stability, I think the balance of risk for this year will be to actually hike, or tighten, its policy parameters.
Well, here's a look at how the Singapore dollar has fared against other currencies of favourite travel destinations. And when it comes to the Japanese yen, the Sing dollar has been gaining ground since 2020, going from 75.6 to around 112 this month. And just yesterday, it was the strongest against the yen in nearly 5 years, hitting 113 yen. For Singaporean holidaymakers, that means a bowl of ramen in Japan, which cost about $13.20 in 2020, would in fact be a third cheaper now at around $9, not accounting for inflation. Crossing the causeway, the same story for the Malaysian ringgit. For most of 2020 to 2022, the Sing dollar hugged the 3 ringgit range before soaring to its highest ever at 3.57. That was in February this year. Our fellow ASEAN neighbour Thailand saw its currency dipping to the lowest ever as the Sing dollar busted past the 27 baht mark. And at the same time, the Korean won. Well, it is also a whisker away from levels not seen since 2 years ago at 10.15 won to this 1 Singapore dollar.
We will likely be holding a appreciating Singapore dollar against the other currencies in the world, most currencies in the world, and that could mean a stronger purchasing power, at least in foreign currency perspective, into 2024.
For more analysis, we're joined by Jeff Howie, market strategist at SGX. Thanks for coming in this evening, Mr. Howie. Singapore's economy growing 2.7% on year. Bloomberg getting that slightly wrong. Their forecast was for 3%. For you, were you more spot on?
Well, we expected some moderation in manufacturing, as Dawn just said. Trade across the region. You can take a proxy of exports in Taiwan, South Korea and Singapore. They were super strong in January, and I think we had some pretty rosy expectations then. But then we saw a lot of moderation in global trade, which flowed back to manufacturing back in February. So a lot of muted growth in trade in February. And it's still mixed outlook for what happens in March when we see our Notics numbers come out next week. But I guess where the surprises were, if there were some, up 2.7% year on year. All 5 of the key industries were up year on year. The strongest were construction, which isn't a big part of our GDP, but it's still important. That was up 4.3% year on year. And then one of the key services segments that's made from 3 sectors. It's made up from information and communications, finance and insurance, as well as professional services. That was up 4.2% year on year. So year on year was strong. But when you look at it quarter on quarter, it was up 0.1% from the fourth quarter of last year. What we did see was that 2 services sectors that actually had a decline in quarter-on-quarter growth in the fourth quarter actually had turnaround expansions in the first quarter of this year. And then you have the other sectors which had super strong growth in the fourth quarter actually saw contractions in the first quarter. So in a way, there was an element of moderation in the GDP numbers from the super strong numbers we had in the fourth quarter. And what we could take from that was that we're seeing more broader growth across all the various segments and sectors of the Singapore market. That's pretty important for us too. At our stock market, we're very diversified over very different industries, very different sectors. So it is actually good news when you see growth broadening somewhat in Singapore.
Yeah, some changing fortunes for the performance of sectors there, Jeff. But let's talk about what we're seeing with the value of the Sing dollar as well, because in 2023, it was one of the best performing currencies, Asian currencies, in 23. What about now? Because it makes a big difference to spending, to trade, where we're at with that. Do you expect the central bank to keep strengthening the Singapore dollar?
I think they will, as the consensus is that they won't change what they're doing. Effectively since, I think, October 2022, when they ceased doing the appreciations or this change in the slope of the appreciation. So they've effectively been on hold since October of 2022. And I think that is the majority of expectations, that they will remain so throughout the end of the year. There are some expectations that they might actually reduce the slope. Now, to do that, it's going to obviously be data dependent. And we have to see, I guess, more evidence of disinflation in our major trading partners. The good news is that also having that policy as it is, that policy band, maintaining it the way it is at the moment, is that it is actually curbing inflation from coming in if it was to come in from our trading partners.
Yeah.
So earlier when looking at the growth figures, you were breaking it down sector by sector, and in fact going even within certain sectors.
Yeah.
Now, should the currency continue strengthening, if you look at sector by sector, and again, within each sector, do you see certain sectors gaining, not gaining, and on whole, a good thing or a bad thing?
Yeah, that's a really good question, because it almost every sector has a different impact. I mean, the overarching impact of tighter financial conditions is to, in a way, curb economic growth, as we know, and it tightens finance costs. So we've seen it work through in the REITs, right? The REITs have had tighter financial costs. That curbs into the income that they can distribute to the unit holders, so that's been reduced. But for the banks, the net interest margins have been up quite strong, from below 2% in 2022 to above 2% now. That boosts their net interest income. For the currency side of it, one consideration is that when you look at the impact it can have in the various segments, we can look at the segments of stocks in Singapore that actually have, let's say, half their revenue in China or half their revenue in ASEAN, excluding Singapore. That's not necessarily a good thing when the Sing dollar is appreciating somewhat,
right,
to where their revenue is being generated. It can actually cut into their bottom line.
Yeah, the hope is that, a strong currency might sort of mitigate against inflationary risks,
which is
right?
what it's doing.
But we have been seeing this higher than expected inflation. It's just sticking. These inflationary pressures, and for the past few months as well, around the world. I think it's eased a little bit in Europe, though. What are the reasons for that stickiness for global inflation right now?
One thing is, aside from the US, is what we don't see so much in Europe, is productivity gains haven't been there. Productivity is great for curbing inflation. You can basically get more output from your labour with less cost, and that is a great way to curb labour-driven inflation. But also, you've got the risk also of food prices, energy prices rising, shocks there. That can also have an impact and rise the inflationary pressures. So it's really important for us in Singapore to ensure that those trajectories of those third quarter of 2022 peaks, the trajectory of the falling away from those peaks for our major trading partners does continue. And if it does continue, that will also have an impact on reducing inflation here in Singapore, obviously.
Okay.
Thanks for joining us this evening, Mr. Jeff Hai, market strategist at SGX. Thank you.
Thank you.